One of the most common words used by prop firms is consistency. You see it in the rules. You hear it in trader evaluations. And many firms say something like, "We are looking for consistent traders." But here's the problem. Most traders misunderstand what consistency actually means. They think consistency means winning every day or making profits every week. But that's not what prop firms are talking about. And in this video, I want to explain what consistency really means in prop trading in simple terms and show you examples on the chart so it becomes clear. I am Fotis Papafeofanos and welcome to TTT Markets. Let's start with the biggest misconception. Many traders believe consistency means smooth profits. Something like this, 1%, 0.8, 1.2%, 0.7 and so on, every day. But real trading doesn't look like that. Even professional traders have flat days or losing days or weeks where nothing works. So if consistency doesn't mean constant profits, what does it actually mean? Consistency means consistent behavior, not consistent outcomes. When a prop firm evaluates a trader, they are not only looking at profit, they are watching how the profit is produced. They want to see stable risk, similar position sizes, controlled drawdowns, and no emotional spikes. In other words, they want to know if your trading process is stable and repeatable. Because if the process is stable, profits can compound over time. But if the process is unstable, the account eventually breaks. Let's look at a simple example. Imagine a trader who trades pullbacks during a trend. Maybe something like this. We have a trend and you buy a pullback here, you buy again here, you buy here, and so on. The rules are simple. Trade with the trend, enter on pullback, risk 0.5% per trade, and target a 2-to-1 reward risk. Now let's say the first 3 trades look like this. You have, let's say, a loss here. Let me magnify this so you can see better. So let's say you take a loss here, you take another loss here, and in this one you have a win. So the outcome, you have a small drawdown and then recovery. This is normal. Consistency here means the trader followed the same risk and rules every single time. Not that every trade worked. Now let's compare that with inconsistent behavior. Imagine the trader takes 2 losses, so you have a loss here and you lost here. Then something changes. Instead of risking 0.5%, you risk 2%. Or you risk 2 positions instead of 1. So you open 2 positions instead of 1. You trade more aggressively. Or you move the stop. Now this behavior is different. And this is what prop firms watch very closely. Not just did you make money, but did you change behavior under pressure? Prop firms are managing risk. Even if they don't directly give you capital, they still need traders who behave predictably. Imagine you are a risk manager. Which trader would you trust more? Trader A, that made 10% in 2 weeks but took just 2 huge size swings, or trader B, 6% over the same time but with stable risk every trade. So most firms would prefer trader B because stability is scalable. Emotional trading is not. Now look at this area. Let's magnify again. This is the Euro USD 4-hour chart. Let's look at this area right here. We have larger candles than normal, we have higher volatility. These are the moments when many traders become inconsistent. They increase size, they take extra trades, they chase momentum. But the market environment becomes emotional for them. Consistent traders behave differently though. They keep the same risk, the same rules. Sometimes, if the conditions do not support their strategy, they might even reduce size. Because consistency is about risk control when volatility increases. And another important point, consistency is not measured over 3 trades. It's measured over dozens of trades. Professional traders think in samples, 20 trades, 50 trades, 100 trades, because over small samples, randomness dominates. Over larger samples, behavior becomes visible. And prop firms want traders whose behavior remains stable over time. Let me ask you a question, and this is the real consistency test for you. What happens after a loss? Many traders are disciplined when things go well. You stay true to the rules. But after 2 or 3 losses, risk increases, revenge trading appears, rules change. That's inconsistency. Professional traders do the opposite. After losses, they trade smaller, they trade less, and they focus more on execution. Because consistency means stability under emotional pressure. Look at this part on the chart, and I'm going to minimize now. I'm going to do this so you can focus on this area right here. Sideways movement, no strong trend. This is where many traders break consistency. They start forcing trades, they try to create opportunity where none exists, but consistent traders do something different. They reduce activity, they wait. Because consistency also means trading less when conditions are poor. So if we simplify everything, consistency in prop trading means this: same risk, same rules, same behavior, regardless of wins, losses, volatility, or market conditions. It's not about having perfect results. It's about having predictable execution. Many traders chase better strategies, better indicators, better entries. But in prop trading, the edge is often much simpler. Consistency. Because a simple strategy executed consistently is far more powerful than a perfect strategy executed emotionally. So the next time you hear a prop firm say they want consistent traders, remember this: they are not asking for perfect results. They are asking for stable behavior. Traders who respect the risk, they follow rules, they stay calm under pressure, and they repeat the same process over time. That's what consistency really means. And that's what allows traders not just to get funded, but to stay funded. And remember, in trading, consistency isn't about winning every day. It's about behaving the same way every day.